Okay, hi everyone. Let's take a look at this partnership accounting problem. So what do we have? We've got the post-closing trial balance of two proprietorships on January 1st, 2020. So we've got the Sorensen Company and the Lucas Company. And here's the post-closing trial balances. And they decide to form a partnership called Blossom Company. And they come up with agreed upon valuations for their non-cash assets. Okay? So here's our agreed upon valuation for non-cash assets. And then there's another note down here. All cash will be transferred to the partnership, and the partnership will assume all the liabilities of the two proprietorships. Further, it's agreed that Sorensen will invest an additional $4,800 in cash, and Lucas will invest an additional $18,200 in cash. All right, so let's take a look at what they're going to ask us to do. And the first thing they want to ask us to do is prepare separate journal entries to record the transfer of each of the assets and liabilities to the partnership. Okay, now I've repositioned the screen so that you can see the solution for Sorensen's assets and liabilities. So below the green bar there, you can see how you would make the entry. So what are we doing? Well, we're putting on to the books of the partnership the items at their cash value by recording debits for the assets and credits for the liabilities at their cash value, but we're using the agreed upon values for the non-cash items. So if you need to pause the video to see where these numbers came from, you can do that. For instance, there's the $17,000 of accounts receivable coming from that agreed upon amount. The $4,300 of the agreed upon amount for allowance for doubtful accounts comes from right here. There's the agreed upon amount for inventory and equipment. Okay? So you might want to pause the video to make sure you know where those numbers come from. Okay, now hopefully you've noticed that the screen moved again. Here's the transfer of Lucas's assets and liabilities. And again, use the same approach. Look, slide above or go back in the video so you can see where these amounts came from. But we can see the agreed upon amounts for Lucas as well. There's accounts receivable, $25,000, the $3,800 of allowance for doubtful accounts, the $19,200 and the $14,400 show up as inventory and equipment. And the other items, let me slide back up, came from actually the cash values, right? Again, these items here are considered to be non-cash items, but the cash items come from the numbers up here. Okay, so that takes care of the first part of this problem, where we're asked to record the transactions and put them on the books of the partnership. Okay, so now let's take a look at Part B. Part B says, journalize the additional cash investments by each partner. I'm reading right here. Okay, and this is pretty straightforward. Hopefully you'd understand. We're going to debit cash. That's the easy part. And really what this question is asking you is to make sure you understand that an additional cash investment in this situation results in the increase of each partner's capital account. So $4,800 from Sorensen, $18,200 from Lucas, and that's how you'd make those entries. Okay, now we get to the final part of this problem, and the numbers may look a little bit smaller at this point. So if you haven't been watching this in full screen, it might make sense to switch to full screen at this point so you can see the numbers. So now all we're doing is we're putting together the classified balance sheet. And if you've been tracking which entries you've been putting to which accounts, you'll see that we're just adding it all together. Right down here you see how we come up with it. We had $13,000 that was debited, then $11,500, then the two incremental cash contributions comes up with $47,500. So that's where we come up with the $47,500. And you can follow the logic as well. We're going to use the agreed upon values that we already recorded and add the various values together, right? And we can eventually use this information and put together the entire balance sheet. And with this, that solves this problem. So I hope you found this helpful.